Sure. So first of all, a big thank you to Sameer for joining us for today's Zoom event. It's a real pleasure to have him engage with current McGillians in this way. Sameer and I first met when he was my student in applied corporate finance. No, I don't even know what it would have been, 2013 maybe.
Yeah.
So
I think so. Yeah, 2013. Yeah,
something like 8 years ago, and he was a student that left a very good and a very unique impression on me in the course, and we'll probably talk a little bit in more detail about that later on in today's session. But after McGill, Sameer went to work at RBS in London for a couple of years, and I still remember, and perhaps it wasn't that surprising when it happened. I was just surprised it happened this early, but I think maybe something like 2 years after you started your work at RBS, I receive a call from you at some point, and you tell me, I'm thinking of launching my own fund. And I was like, I love the entrepreneurship, but you're like, how old were you at the time? 20?
When I officially quit RBS and set up, well, when I was working at RDCP and quit RBS, I was 22. Actually,
22. Holy cow! So even younger than I thought. And my reaction was, love the entrepreneurship. LPs usually like to put money with older people, right? But I still remember kind of what you did after that initial conversation, which is that you really kind of approach things like an entrepreneur, which is another theme that we'll try to touch on today, which is you're like, look, you'll take the landscape as it's provided to you, and you're going to optimize the best opportunity around it. And you ended up launching something nonetheless, and starting small, with your own capital and family capital, really starting with, I think it was like 3.5 million in capital.
Yep.
And not taking any outside capital. And you started to roll with that, right? So you started to learn and grow, and you basically learn and grow. Power of compounding. We sit here now, and really only less than 6 years later, right? RDCP, the group that you founded out of this, and now controls $400 million of investments. I mean, what a story so far. And from my perspective, still in the early chapters of a book. So I've really enjoyed reading it so far. And I think today is a wonderful opportunity for you to share some of this with students, both to kind of give them a little bit of know-how on stuff, and also to inspire them, hopefully. So I think from here, it makes most sense to let you take it from here. And maybe first part of our session, we'll talk about the business you've built, RDCP Group, and then maybe the second part of the session we'll talk more about you specifically. So maybe we can start a little bit with the origins of RDCP.
Yeah. So as you alluded to, right, we started super early, and so me and my partner, who's also my wife, Irina Dubilovska, we met at RBS, and both of us were sort of graduate analysts, and we met in the very first week in the 1 month training that you do as an investment banking analyst. And both of us, sort of like a lot of the students here today, probably were like, investment banking. Gosh, this is the dream. I got an investment banking analyst role. This is what everyone wants, right? Frankly, RBS was one of the lesser banks, but still, nonetheless, they had a strong IBD program. But we started, and very quickly, it just wasn't for us. We liked finance, and we liked the idea of investing, but investment banking was not quite what we wanted to do. And very quickly, you realize just how rigid a place it is, and it's almost military. 3 years as an analyst, 3 years as an associate. You don't talk to a client until you're a VP. So I would have to be my age now before I speak to a client. Things like that, which just at the time didn't seem logical to me. So me and Irina very quickly started talking about what is it that we want to do, and I showed her my idea that maybe when I'm around 30, I'd like to set up Rizvi Capital or something along those lines. Not sure what we're going to buy. Not sure, is it going to be a hedge fund or private equity fund? I have no idea what it's going to be, but I want to be investing. I want to be in the market. And she asked me the question, well, why not now? And I said, people are going to take me more seriously when I'm 30. And her point was, unless you're spinning off some big fund at the age of 40 or 50, there's no big difference in being taken seriously at 30 versus 22. If anything, at 30, you probably have a mortgage, you might have a kid. Your ability to take risks dramatically reduces every single year in your 20s. So we just got going. I quit first, she quit a month after me, and we set up RDCP Group. At the time, it was called RD Capital Partners, eventually rebranded to RDCP Group. But as you said, we thought out, we wanted to be a private equity fund manager because of, and this goes to some of the things we talked about last time, Jiro, because we struggled to raise LP capital, because I was 22, who was going to put money, substantial capital with us. We decided to, let's start investing. I borrowed all my dad's net worth. He gave it to me, which I'm super happy about. Irina, my wife, took 100% of her inheritance from her late father, and we borrowed maybe 700K of friends and family money, and these are like friends of my dad's, a couple of friends of mine who were willing to put 200K each. So our pot was $3.5 million, 2.5 million pounds. And we thought, let's invest this and eventually we'll go raise a fund. But that eventually never happened, effectively. We just really enjoyed running our own money. And because when you have a limited amount of capital, you can compound at rates which sound ridiculous, frankly. And so we thought, why not just do this for ourselves? And that's what we've done. And one of the facts I'm very proud of is the fact that me and Irina own 100% of RDCP Group. And in particular today, when we're competing with private equity mid-market investment firms on acquisitions, when we're trying to buy a competitive auction process on an acquisition and 5 other private equity buyers, our selling point is, this is our capital. We're going to be way more vested than another no-name private equity firm, because we're going to be in this for the long run. We're providing permanent capital, whilst no other private equity can do that. And that's how that's become what was our weakness at the very beginning has become our differentiator now.
Absolutely. I mean, and the notion of patient capital, by the way, you guys were ahead of the game there, because you actually see some PE, for instance, Sequoia VC, right? Just recently said that they're doing an evergreen fund, right?
Okay.
I think in some sense, in terms of the positioning of the fund, you guys were ahead of the curve there.
Sure.
And it seems pretty clear to me that there have been benefits that come from that. And it certainly seems to be like a very good and credible value prop when it comes to acquiring other businesses, especially when it's, folks who really care about their business and want to make sure it's going to be run the right way. But maybe we can kind of go back a little bit to the origins, and maybe you can tell it, right? You 2.5 million pounds, you can't dabble in everything. So you end up focusing on something specific. Maybe you can tell us a little bit about that and your reasoning behind it.
So so when we were setting this up, and in particular coming out of McGill, and I'm sure it's the case now, 7 years later, the sexiest industries always are technology. I mean, I'm sure everyone here, you want to go into investment banking, you probably want to be in the TMT team because you want to do technology, media, telecommunications. It sounds sexiest. In the same way, if you're setting up a fund, most of the time you think, I want to be doing venture capital. It's going to, that's what I should be doing. It's so cool. But actually it's the one that makes builds the least amount of wealth for the founders, for the founders of the investment fund. And you need to have a lot more capital because, I think that the numbers are something like 1 in 20 of your VC investments actually work out. You're going to lose money on 19 of your 20 investments. So for that amount of capital, we had to do something that was relatively low enterprise value to EBITDA multiple, so relatively low multiple, so we could buy it at below intrinsic value generally. And 2, it had to be cash generative, such that we could take that high cash generation of the business and reinvest into more businesses. And that's so we in order for this to work, we had to be in a sector that would allow the compounding machine to start as early as possible. So we picked elderly care. So we picked healthcare, specifically nursing homes and the elderly care market. And that was the smartest thing we've ever done. In the first couple of years, we were purely 100% of our business was invested into the healthcare sector. Subsequently, we've diversified away, but for a while we were purely focused on healthcare. And that, in fact, those early days were crucial because those businesses that we bought in the first few days have funded a lot of our further bolt-on acquisitions. So yeah, we thought quite a bit about what sector we wanted to be in, and we picked sort of asset-backed healthcare.
And I mean, you didn't have a background or that many connections into that industry at the time.
No,
so
none.
It's one thing to have the insight. It's another thing to execute on the insight and to learn to be able to execute better and better and better. Maybe you could comment a little bit on that.
Yeah. So I mean, our time in investment banking was so limited, right? So it's quite funny you ask this question because people in general always try to compartmentalize you. So even when we were starting out in the healthcare sector, the question was, were you doing healthcare coverage at RBS? And no, we weren't. They didn't even have they didn't have a specialist healthcare team, and we were not doing that. But for us, it was more about with our limited amount of capital, are there enough assets in this, or can we buy sufficient assets with the limited amount of capital that we have? Is this a sector we can also borrow against? So are these businesses where we can use very cheap bank debt to sort of again to leverage our equity capital? And the answer was yes, and that's how we were able to execute. And that's also when I started to learn it's so much harder to raise equity capital. So it's so much harder to raise LP capital for a fund versus a bank. Their job is to put money out the door, right? So all of a sudden we found, hey, we're talking to the wrong guys. We should be talking to banks, not LPs. And then all of a sudden it went back to Finance 101, the pecking order of your balance sheet. You know, your cheapest form of financing is internal funds. Your second cheapest form pretty much is senior bank debt, right? It doesn't get cheaper than that. So when you have banks lending you at 2%, why don't take that money and invest it at 30 or 40 or 50%? Instead, why would you go raise equity capital that is the most expensive form of capital on your balance sheet? So it was those basic finance lessons which I could just see in practice.
By the way, maybe I can take a second here to pause because there's something that I want people in the audience to note on. If you kind of listen to the way Sameer answers questions, and I think this is kind of one of the things that I noticed when you were my ACF student, actually, which is the way that Sameer reasons through stuff is what I would call first principles thinking, right? So notice like the questions I answered, the way he answers it is he provides an answer from the ground up, usually hinging on pretty simple logic. I like that you actually referenced, Finance 101, because in some sense it's about that, right? It's the basic observations that you use to build up to kind of understand like, well, why does navigating to this area make sense? Now, I think this is actually very important. I think it points a little bit to how RDCP Group has evolved over time, and maybe we'll retouch on this a little bit later, which is one of the things that to me makes sense, given the way that you tend to think through problems, is your insights tend to be repurposable in many ways, right? So it's not like you need to complement that, of course, at the end of the day with detail orientation to make sure you do the general principles the right way when you decide like where and how to enter the elderly and specialty care space, right? Like details matter, but before the detail, you first capture a general insight that's based off of basic fundamental first principles. And so this is something that I hope students in the audience appreciate, which is the importance of that type of thinking. And to be honest, I mean, it unfortunately is a bit of a type of thinking that isn't emphasized enough in the classroom. And so that's why I think it's important to have events like this to kind of highlight that. And I think Sameer's a great example of that. So,
I think, Jiro, it's interesting you touch on that, in particular because in finance, of all sectors, there is such a natural push towards over-financialization of everything, right? Everything has to be over-financialized. overusage of terminology that makes you sound smart, but you really don't need to use, right? So if people ask me, how did you build your business? I bought businesses for as little money as possible. As simple as that. Whilst I could give you a very, something that would appeal to an investment banker, answering the same question would give a much more utilizing every single terminology that you can imagine, but you don't need it, right? And sorry, go on.
No, actually, I think I know the answer to this, but I don't think we've talked about this before. So I'm actually curious to hear what the answer to this is. Like at the detail level is a big part of you making sure you get the details right. A lot about, especially when you're expanding to something new. So like that first time you did something in the elderly care space, you make sure you buy a company that's run by the right people, and then you can learn from them. I'm curious.
So the company, so let me answer your question. So the company today is, me and Irina, I'm 29, Irina's 31. We're still relatively young, right? Compared to the CEOs. So we have 6 CEOs. So we have 6 businesses at the moment, 7. I think the information memorandum I sent across to you for the class, that has number 7, which is a deal being announced publicly in a couple of weeks. So it'll be 7 CEOs that report to us. Each of them, the average age range is between 45 to 60, right? So these are guys who have been in their sector specialists, and been working and living and breathing it for the last 30, 40 years. So for me to pretend to be as detailed a specialist as any of them is just not true. I know what I'm good at, and my circle of competence is good and it's wide, but I know what it is and it's very well defined. Whilst these guys, the reason this model or any strong investment model works is because you have very strong leadership running the operational businesses. So look, I sit on the board of every single one of these companies. I'm a fairly active board member, shareholder. We challenge as much as possible. It's very data driven, so very detailed financial information every single month comes to me, and we challenge where we can. But ultimately, we give the leadership autonomy to run with it, and it's been the reason for our success. If I was micromanaging every single business, A, probably wouldn't be as profitable, and B, we wouldn't be able to grow. So no, you're absolutely right. That is probably one of the most important parts. So once the business is right, the financial history is good, the price is right. The base for all this is does it have strong management? And that's very important.
I mean, I think actually this discussion actually blends nicely into talking about the more recent subchapters of like how RDCP went from RDCP to RDCP Group. So maybe you can talk a little bit about that.
Sure. So do you mean from being an investment manager to purely being a holding company?
Oh, no. So I mean more like to go from, focused on elderly and specialty care to other sectors.
Sure. So our vision always was, and we would look at the companies we most admire, and Berkshire Hathaway is by far the top of that list, right? So, Berkshire Hathaway, do they have certain sector concentrations? Of course, insurance is one of the bigger sectors. Apple is a big holding for them today. But for Warren Buffett and Charlie Munger, it's about the market generally. It's about businesses generally. Their passion is investing. Their passion is Berkshire Hathaway. Likewise, my passion is investing. My passion is RDCP Group. We had to start somewhere, and we started with elderly care and healthcare in general. And like I said, that was a wonderful place for us to start. But we never wanted to be a single sector investment firm. So we're single at the moment. We're single country. We're UK only. So if you're UK healthcare only, yes, that's a couple of £1 billion industry, but still you're going to be competing for the same assets. And what we started seeing is we paid an average multiple of 4.9 times, right, for the businesses that we bought in the elderly care sector. As we kept pushing and looking for more similar transactions, the average price multiple was rising closer to 10. So, and that was happening at a time when the healthcare sector was getting much hotter. So it was a natural time for us to diversify into other sectors, because the last thing I wanted to do is, do I love the healthcare sector? Absolutely. Is the population aging? Of course. Is there an undersupply of beds in the UK or in Canada? Absolutely. But for us, it was about, this is the time to move into other sectors and find arbitrage in every other market. And that's what we started doing.
Yeah, by the way, I mean, I like that you brought up Buffett, Munger, and Berkshire Hathaway, and the fact that they are, I mean, again, loosely speaking, sector agnostic.
Yeah.
I mean, because in some sense, when I classify them, I think of them as being, some of the best examples in the world of first principle thinkers, right?
Absolutely.
And then they pick the right people to run the different subparts. So, I mean, there is like a parallel behind what I view as some of your biggest strengths and what I view as some of theirs, which, by the way, is the reason why, as you know, I like to call you the Oracle of London.
That's like the biggest compliment ever, by the way. Because, and for the people in this room, I'm not a religious I'm not a religious man, but if I were, Warren Buffett would have God status, because there's no investor who's done it for 7-8 decades now, so consistently compounding at 20% a year. By the way, after this session, go on Excel, put 100,000 or 10,000, compound at 20% for the next 70 years. Look at how much capital you end up with. It's as simple as that. So back to first principles. That is all he's done. He started with a decent amount of capital, initially in a partnership, which was kind of like a hedge fund, and then eventually a holding company, which is Berkshire Hathaway. All he's done is compounded slowly, and 20% is no mean feat. And he was compounding at significantly higher rates in his first few years, but it is as easy as it sounds, and it's much easier with limited capital.
I mean, another thing I'll actually just kind of note to the audience is I think it's actually very useful to think about. One of the ways that I classify what Sameer has done over the course of his career, especially with RDCP Group so far, is I feel like he's defined his journey, his career, his business activities in a way where he's leaned into his strengths, right? So if you view one of Sameer's strengths as being first principles thinking, the idea that he would build something the way he built it in a manner that ends up navigating towards being sector agnostic, but taking bets that rely heavily on the validity of his first principle judgments, right? It makes sense why this would be the right path for him. Now, this is not necessarily the right path for everyone, right? So there is this aspect here where it's important to have a level of self-awareness so that you know what your superpower is, and you define your game in a way that best leverages that superpower. And I can say personally, when I see people do that, it's actually very touching, and it's something that makes me very happy to see. And that's one of the reasons why we have these regular chats, is it's always nice to see that stuff. Maybe just to kind of continue a little bit, right? So we've talked a bit about the origins. We've talked a little bit about the recent and present. Maybe we can talk a little bit about the future, which will make this video interesting to see in a few years.
Yeah, absolutely. You mean, where are we going?
Yeah.
Yeah, sure. Okay. So
tell me the future so I can make a few bets the right way.
Sounds good. So it took us a while, right? So for a few years, we kept, for a while we thought we're going to have our base portfolio, we're going to raise outside capital because we need outside capital to be a substantial investment firm. I was wrong, as proven by where we are today. And we're now, since 2020, we have a very, very clear idea of who we are and where we're going. And by the way, for the students in this classroom, you don't need to come up with something inventive. Just copy some of the best mentors or best examples out there. And we're trying our very best to copy Berkshire Hathaway as best as we can. We're another company, an investor I admire is Sam Zell, trying to copy what he's done. He started in real estate and then moved into equity investing. So we're trying to copy his, I've read a couple of books on Sam Zell, and I'm trying to mimic what he's doing. Because we are where we are today, Buffett started in 40s, 50s. We're starting, we started in 2015. We have to have a natural, we cannot ignore technology, right? So another investor I admire is Shamat Palihapitiya, who runs Social Capital in California. Another sort of outspoken investor. So between these three, we're just copying them. So we're literally copying them as best as we possibly can, right? So to answer your question, Jiro, as the capital base increases, our rate of return, annualized growth rate is naturally going to drop, right? Because we're working with more capital, deal making is getting more competitive. There are fewer deals at this size, so our growth rate is going to drop. Having said that, we still are continuing to find underpriced opportunities in the UK M&A marketplace. So our goal is we're $400 million now as our sort of enterprise value / assets under management. We'd like to get to $1 billion as quickly as possible. I would estimate that the earliest that's going to happen is sometime in 2024. If we're extremely lucky and a few things go right in our direction, it could happen by the end of 2023, but realistically 2024. The other thing is, in order to be, in my opinion, in order to be taken seriously as an investor or as an investment firm, you have to manage or control at least $1 billion in assets, is my genuine in US dollar terms. So we're just so focused on growing the business to $1 billion. And we'll also be super proud of the fact that that'll just be balance sheet capital. No, that's not, it's one thing to go and raise $1 billion. We're not raising $1 billion. We're investing and compounding to $1 billion. That's, for me, a way more interesting journey and story. So yeah, we're trying to get to $1 billion as quickly as possible.
Fingers crossed, I have no doubt. But one thing I'll mention is, one thing that you to the audience, right? One thing that folks shouldn't get from this is that everyone should try to be Buffett or Sam Zell or Chamath. I mean, I think an important part of this equation is that Sameer has picked examples that actually, if you look at all three of those people, or I mean, I guess four if we include Charlie Munger, again, they kind of have a similar superpower to what Sameer has, right? So I think kind of like step one in thinking about these case studies that you focus on is to first actually focus on yourself to see what matches well with you. And the other thing I'll mention is like Zell versus Buffett Munger versus Chamath, they've got similar superpowers, but if you look at the details, they've done it a little bit differently. So that when you look at the case studies, it's not three of the same case study. It actually maps out a few different things, which is important because who knows exactly how the world is going to evolve. And so what's nice about the examples that you draw from, Sameer, is that you're better preparing yourself for an uncertain world so that you can zig and zag a little bit depending on what the world tosses your way. And in some sense, like what you've done with RDCP Group already highlights that, right? What RDCP Group is now is not exactly what you envisioned at the beginning, and it required you to be adaptive, right? I mean, in some sense, that's part of the entrepreneurial essence of what you've done, is that you need to make adjustments to the way Mother Nature tosses stuff at you. So a few things that I would definitely take away from all of this. Now I'll want to speed along a little bit because I do want to leave enough time for students to ask questions. So maybe we can shift a little bit away from talking about RDCP Group, even though we could probably talk about that for several hours. But instead, maybe start talking a little bit about you specifically and kind of the personality characteristics that you have that, again, have allowed you to kind of lean into those and again, so far, really achieve wonderful things with RDCP Group. One thing I'll mention, I kind of hinted towards this at the beginning of the event, is, Sameer did actually leave a pretty special impression on me when he was my student. And by the way, it wasn't because he was the absolute best student or the absolute best test taker. There's like a category of student that I have in my mind that I always pay attention to what these students are going to do down the road when I identify them. And I only identify maybe a couple a year, but I call them my special A- student, which, by the way, special A-, you do the acronym, it's Sam, Sameer. Okay, interesting. You're one of my original Sams. But what is a Sam? A Sam is a student that I can tell from the classroom experience is genuinely curious, but I also tell that they don't give a shit about the grade I give them. They actually don't care so much about perfecting every little dot the I, cross the T of the specific application of logic that I teach in the course. Yeah, they're going to do it. They're going to do it well enough. But what they're really curious about is how they can take the essence of the lessons, the 101, the finance 101, the logic 101 of the stuff I teach, and they can make it their own by redeploying those ideas to their domain, to the thing they're interested about, and that they care a lot more about asking questions that relate to that than that relate to like what they need to do on the homework or how they can prepare for the final exam. Yeah, when I see students like that, like it's potentially my favorite student, because I think that's the right way to learn. Yeah, that's really, go ahead.
Sorry, just on that, it's interesting you say that, right? Because if I had to pick one of the things that's been the driver for me and Arena, and both of us are quite similar in this way, is done is much better than perfect, right? And there's a term called analysis paralysis, right? And oh my God, I bet there's a huge group of people that are just, and I got asked these questions every year for the last 6 years, right? Sameer, did you have the business plan laid out as you quit the job at RBS? Did you know you were going to buy this business? No, right? You just have to, you decide that this is what you're doing, and things get thrown at you, right? There's no curriculum. Once you quit your job, or once you quit your job, because banking is designed perfectly for students, right? Because it's such a clear curriculum, investment banking. So people love it. A good student will love it because it's so you know exactly what you're doing. There's a monthly training, and it's ideal for folks that require that sort of tick box lifestyle. But once you set up your own business, especially the way we've done it, there's no curriculum whatsoever. You buy what you want. You can raise capital the way you want. The world is your oyster, which can be pretty scary. But it goes back to done is better than perfect. Otherwise, you'll never move forward. Say applies to acquisitions. Are we always 100% sure that we've done every bit of due diligence, that nothing is going to go wrong here? No. You ultimately got to rely on your gut, and there's some risk taking, right? That's where no risk, no reward. So it all comes together in sort of investing in entrepreneurship. And frankly, that I would say that's one of the main drivers of our success.
Yeah, I mean, I think there's like two like important things to draw from what you just said. One is, as you said, like, get things done, and that means that you need to have a tolerance for the risk of failure, because if you wait for full de-risking, it ain't ever going to happen. So tolerant, like being willing to fail, is fundamentally important, especially if you want to do anything really big. Two of my favorite quotes of all time. One is by Wayne Gretzky: "You miss 100% of the shots you don't take." Right. The other one is by Thomas Edison. "Learning things. I've learned thousands of things. I've learned thousands of things that don't work." Right. Yeah. Two of the most successful people in their domain ever. And they give you these, life-altering quotes about failure. It says something when the successful people say, you gotta be willing to fail. That's super important. The other thing is the notion of learning to learn and self-learning. As you said, there's no playbook when you're trying to do something new. And so
No.
a big part is that you need to equip yourself to be able to teach yourself and not to rely on a rule book given by others. And so maybe on this last point, we can touch a little bit on this. Maybe you can tell us a little bit about your approach to learning, and maybe also how that's evolved a little bit from McGill to RBS to RDCP Group,
Sure.
and whether there's any of the best practices you've come across now that you
Sure.
think you could have implemented earlier.
So no, absolutely. So reading is probably one of the best ways to take things away. And my library is behind this laptop, and I have 9 Warren Buffett books and 3 Charlie Munger books, and a whole other load of books. But my learning has become very selfish over the last 6 or 7 years, right? So I cannot read fiction. I just some people enjoy it. For me, I'll just go watch a TV show if I want something that's fiction. So if I'm spending the time reading something, it has to be super applied. And so back to selfish thing, it is super applied. So I'm only reading things that are helping me run my business better, invest better, think about leadership or success or successful investing or just becoming a better person. So my reading has become very selfish. I think that's pretty. Reading is key, and learning from people that.
Can I ask a clarifying question on reading?
Yes.
How much time do you spend reading versus reflecting on what you read? I mean, I know it's not like a fixed percentage, but
sure.
You say the latter part is just as important as the former?
Just as important. So, right. So let's talk about that then. So, funnily enough, until Jiro, because we did a prep call a few weeks ago, until we did that call, this thing that I do, I just thought it's a thing I do, and I didn't really ever think I never took it away from like some Business Insider course or anything like that. So I journal, first of all, which is very helpful, right? So it helps to reflect back. So I have journals. It's just a Word file for each year, and then I PDF it at the end of the year, and then I can reflect back a few years later. So I journal, which I think is super crucial, because when you're trying to break down a problem, putting it down, getting it out of your head onto a screen or by hand is super helpful. But the other thing I do, which I find super useful, is I have an Excel with a tab for each year, broken down, and each year is broken down into quarters. And I have very clear sort of RDCP goals, life goals, fitness goals, and that helps me track moving forward. And I don't try to set 5 or 10 year goals. I have a very clear idea of where I want to be, but I set, so November, December time, I'm setting very clear goals for 2022 already. And most of the time it's like, I want to try and, if we want to get to $1 billion by 2.5 years from now, 3 years from now, we need to try to get as close as possible to 700 million next year. So I've broken that down further into quarters. Well, we need to, about 80 million per quarter for each quarter the next few years. That's a lot of acquisitions, or those are large acquisitions. So it's a lot of work, but I write it down, right? So and that's how we've done it. And sometimes, and it's malleable, right? So as the year is passing, okay, well, I didn't hit that this quarter, I'm going to do it next quarter. So it's malleable. You're always moving it, but it's so until we had that conversation, I didn't necessarily think that was such a crucial piece of just managing it all, but it is, and it's actually helped put it all together, bring it all together. And it also helps to reflect. You look back, you're like, wow, I achieved that back in 2017. How proud was I of that moment back then? Now it seems so insignificant. But I remember in 2017, we were celebrating the 10 million milestone, and me and Irina got a honey cake to celebrate the 10 million milestone. And it was such a big deal at the time. And now in retrospect, so it's about just remembering those and reflecting back on those.
Yeah, I mean, in some sense, it's a device to both better prepare you for the future and to better appreciate the past. And by the way, a lot of people that I really respect and admire do some version of what you just said, right? There's a, by the way, for folks in the audience, if you want one description of this kind of approach to thinking through what you're going to be doing going forward and reflecting on how you laid out something similar in the past, there's something called OKR, O as in objectives, KR as in key results. So something called the OKR methodology, which is hugely popular. in startup circles. It was kind of popularized by really one of the legendary Silicon Valley leaders, Andy Grove, whom I know you've read his stuff as well. He was the longtime CEO of Intel. So check it out if you're interested. It kind of further deepens what we've just discussed right now. Everyone has a slightly different system on the details. So as you said, you've got, you know, a notepad document and a spreadsheet. I use Evernote and have like a ton of notepad documents, some of which I share with my mentors and stuff like that. So everyone at the detail level has a slightly different system, but if you kind of abstract away from the detail, there's a lot of similarity between, again, a lot of folks that I think have gone on to do really, really cool things. So thank you for sharing that with us. Go ahead.
And just sorry, last thing on that before we move on to the next bit, is because if you don't, time is just passing by, right? You know, years just pass by. And I have a kid now, right? And time goes quicker once you have a kid for some reason. So if you're not goal setting, if you're not thinking in months and quarters and weeks, and it just passes you by. So you absolutely have to, otherwise you'll be 10 years down the line and think, gosh, I had that dream at 20. Where did that go? You know, so
by the way, that's one of the things that's a little bit interesting here, right? Because if you haven't done it before, if you haven't taken the time to reflect, you may actually think that taking the time to reflect slows you down and is a waste of time. Whereas, and by the way, this is probably related to the power of compounding, right? But it's compounding human capital rather than financial capital, which is that actually, no, that's not a bad use of your time. It is what is going to supercharge you in the future. It just, you don't see it right away because it takes time to stew, right?
Absolutely.
Anyway, my view is people should do that way more. I mean, I think we could probably go on a multi-hour rant on how probably both of us feel that like some implementations of education actually disincentivize that. But maybe we won't do that today. Maybe instead we can talk a little bit about, you know, a little bit about like what you think your, you know, like what are the personality characteristics that you think have helped you in the kind of combination of entrepreneurship and investment, and also maybe comment a little bit about what keeps you hungry. Because, you know, one thing that's very clear is at this stage, if you wanted to, you could just put the brakes on growth and just let your existing businesses generate cash flow, pay down that debt, and live a fabulous life from now to Cap T.
Sure.
But that's not what you want to do. Maybe talk a little bit about that too.
Sure. So what was your first question? Because
first question is just generic, like, hey, what are the personality characteristics that you think have like helped you along the way?
So I would say, and I was thinking about this recently. It's and I haven't coined a term for it yet. Maybe I will at some point. But off the top of my head, I would call it aggressively patient. So you want to be super aggressive when it comes to pushing for your goals in that month, in that quarter, in that week. You're trying to win a deal. You don't have the most capital. Well, be the quickest. You know, show up to the business the next day, whatever it is, right? Be aggressive when it comes to that. But when I say aggressively patient, be patient with long-term investing, right? So if there's one takeaway from my entire time in McGill Finance, it's the power of compounding. And that I know we talked about it a couple of minutes ago, but it applies not just to your capital, which of course it does, but also to relationships, to business in general. So if you actually utilize that intelligently, it starts to pay for itself several times over. So I would say utilize compounding wherever you can in your life and in your careers.
Absolutely. By the way, I actually like the term, as I think it's the first time you've mentioned it to me, aggressively patient. It's fun because sometimes some of these great anchor points on how you approach decision-making combine terms that at first glance seem contradictory, right?
Yeah.
Aggressively patient doesn't make sense at first. You think about it a little bit more, you're like, that makes a lot of sense. right? Same thing, like, so one of my mentors who I lived with for a year, he's one of the best like identifiers of talent that I've ever met in my life. And he talks about vision, and he talks about how the right founders that will do the absolute like new things that the world has never thought of before, they need to be super firm on the spirit of a vision, and they need to be ultra flexible on the details of executing a vision, right? Now, being firm and flexible just sounds contradictory at first, but when you think about it, it's not. Being aggressive and being patient, when you think about it, it's not.
Exactly
the
that.
event that you went to last year with Kevin Tawil, Divine Discontent, doesn't make sense at first. It makes a lot of sense. And maybe these simple observations of like, most people, when they don't think about it, they never think of combining the 2 and 10 ethic, right? And maybe that's what allows the people who see the complementarity of these things to actually be a little bit contrarian in how they end up doing it in a way that works, right? Contrarian and right, that's the holy grail, right? So
that is absolutely.
So absolutely. So maybe comment a little bit on what keeps you hungry.
Yeah, so I do a lot of, I constantly reflect, right? So I'm constantly making comparisons of RDCP, where it is in the first 6 years versus where Berkshire Hathaway was in the first 6 years. There's a company which probably most of you wouldn't know in the UK. It's called Octopus Investments. About a 20-year-old business, but the founders of Octopus set up their business in their early 20s as well. So we do a lot of parallel comparisons to how Octopus grew in the first 6 or 7 years versus how we've grown in the first 6 or 7 years. So for us, we are constantly doing that, and we're reaching the conclusion that we're so privileged and I'm very grateful about this, that we're ahead of some of these people. Maybe because we've taken all of their collective learnings and implemented it into RDCP Group, but we are ahead. So we have this unique once in a lifetime opportunity to not stop, because if we keep going at the rate we're going, even if we compound at 20, so we've been compounding, by the way, and it sounds ridiculous, but we've been compounding at about 170% per annum for the last 6 years. That's the only way you can take 3.5 million to where it is today. Will this carry on? There's no chance. It cannot. It will drop to 20, 30, 40%, which is still fantastic. So no, there's no reason to stop, because I feel like we've nailed what is, to me, so simple, but nobody else seems to be doing it. For me, a very good example is Berkshire Hathaway, for the longest period, had like 3 people in the office, right? Berkshire Hathaway today, and what do they manage, like 600 billion or something like that? They still have like 20 people in the Berkshire Hathaway office. I come across private equity firms today that are managing like 200 million, and they have 30 staff members, right? And it's like, why do you need so many human beings to do what exactly? So I love that we have simplified investing, and I think and I just want to keep doing that, and I want to keep proving people wrong. We've never spent a pound on marketing, by the way. Things which seem so, nobody else gets it, and I've never had a PA. I don't need a PA. I can manage my own calendar. Everyone my size, our companies, they have multiple PAs. Things like that. I'm so proud of, and so we're going to double down. There's absolutely no reason to stop now.
That's awesome. Maybe I'll open up to student questions now.
Please, of course.
First question, Matt.
Hi, thanks for speaking today. It's super interesting. I've got about 10 questions, but I'll just limit myself to like 1.
No problem.
So you're operating this, holding company, but essentially a part of that is assessing different industries and obviously different companies within different industries. Firstly, how do you educate yourself on each industry to know that you like the dynamics enough, 1, to buy into it, and 2, to buy the business for the long haul, which is your holding company?
Sure.
And 2, when you start to think of changing in management, how do you envisage that? Because that's like, if it's a founder-built company, it's very different to whether you're employing someone else. So how are you? Yeah, I'd just be curious to how you.
Sure. So So when it comes to different sectors, you're right? I mean, in the last 2 to 3 years, we've entered sectors we never ever looked at or thought about before. The only reason it works and it can work is the process starts with obviously the right company, generally the right sector. We have some general information that the sector is doing okay, and it will carry on in that direction. But the turning point always is actually that CEO, the guy I'm going to be working with super closely, he knows what he's talking about. So an early meeting with the CEO or the founder CEO, as long as we get that buy-in, that's when we get really comfortable. Obviously, there's other ways. We work with some good mid-market, market-leading commercial due diligence providers, political due diligence providers. So there's certain sectors which have political tensions or generally commercials that we might not understand. So there's guys who will issue some very, very detailed reports on it. Sometimes our lenders require it. So we do things like that, which is typically gives us the reassurance that we need. But frankly, it comes down to, we don't need to employ a sector specialist, investment manager to enter certain sectors. It comes down to logic a lot of the time, logic and sort of rational thinking. Are we going to be buying burritos? Yes. Is this particular company sort of where does it sit in the marketplace in the UK? Does it have a strong enough position? Does it have some kind of moat? Okay, it's things like that. So it's not super well defined, but it is about your gut feeling, your logic. I think that's, and again, it's soft skills, right? It's very hard to quantify, but it's about, if it's a consumer product, would I eat this? Would I buy this? Why haven't I heard of this before? That's a red flag. So we just came across apparently one of the largest furniture providers in the country. It's 100 million GBP transaction, and me and Arena, an okay price, are backing away because why haven't we heard of this? It's a bit of a problem that we're in the UK. We've been in the UK 7 years for me, 12 years for Arena. Why have we not come across this furniture company before? It's a consumer product, so we're backing away. So it's things sometimes as simple as that. So yeah, I hope that answers the question. But to answer, to summarize, it has to be, you have to use your rationality, you have to use logic. When those are not sufficient, you hire very specialist consultants who will do a report for you. But before the report, even, it has to be logic and rational thinking.
Interesting, thanks.
And your other question was, sorry.
Go ahead.
Yeah, just the transitioning from management. So from founder led to just as an operator, it's a
So so we try to avoid businesses where we're the ones offering that transition, because that is fairly risky. If we are offering that transition, we need to build in a massive margin of safety, right? So I need the price to be much lower than what it is, because EBITDA profitability will drop. I still want the price to be right at that featured lower profitability level. So if we are doing it, we build in that margin safety, but typically we avoid it. So we either make sure the founder CEO is continuing to run it for at least 5 years, or we work together such that we hire someone together, but he or she still sits on the board and is still a shareholder. But yeah, those pure transitions where they're sailing off into the sunset and we're moving in, I try to avoid those.
Oh, thanks.
No problem.
Maybe one quick thing. Sameer, I think you had said that you have a little bit of extra time.
I made sure I have no meeting scheduled for the next half an hour, so I'm good.
Okay, awesome. So we'll continue going through questions, because students usually have good ones. So maybe we'll go with Hugo next.
Yes, hi. Thank you, Sameer, for sharing. I think your perspective on having simplified everything, you passed on the company because you had never heard of it. I think it's a pretty interesting perspective, and thank you, Professor, for hosting us. My question is, with regards to scaling a business so fast, I think somebody asked a question on this in the chat, kind of along the lines of this, but I don't know if you guys had any legal backgrounds, for example, but kind of those different factors that come in to present themselves as challenges when scaling a business so fast that maybe you weren't expecting when you were first getting into the business and starting the company.
So the way we've been able to do it is it's always been about quality over quantity when it comes to acquisitions. So when we were smaller, we were acquiring businesses that were smaller and generating less sort of annual profits and annual revenues. But every year, so the way we were able to combat, Hugo, exactly what the fear of sort of overstretching ourselves is every single year we're increasing our minimum threshold. So things that we bought a year ago, we wouldn't consider anymore because it would be too small. And hence we're still only doing about 4 acquisitions a year. It's just every year the average transaction size is much larger compared to the previous year. And that way it's the same amount to manage if you think about it. I think you asked something about legal. We have really strong advisors. So you know, whether in the UK, US, or Canada, you know, some of the best lawyers and accountants in the world, right? So and you don't have to break the bank for it. Good mid-market advisors, they work their ass off to make sure you're protected. That's their job. You know, my job is to make good investments. Their job is to protect me from any downsides. And so as long as you're partnered up with the right people, we haven't had any issues. You have to work with lenders and the very CEOs of your company have to understand your vision, because if you didn't share your vision in the first place, then they might think, you know, are they growing too quickly? Are we not relevant to them anymore as a company because the group is growing so fast? So as long as you make your vision abundantly clear to everyone, all stakeholders, I think you then further reduce your risk of overscaling. And that's also why, by the way, I started issuing annual letters. So I did our first annual letter in 2019, then one in 2020, and I'll be releasing our new one in probably a couple of weeks. And that way, because we have 1,750 employees now, anybody can just pick that up and sort of understand where we're going. Any lender, any potential business that we're buying into, they can understand exactly what I'm thinking. And I try to be as transparent as possible in this letter. So I think that's how you combat it.
Makes sense. Thank you.
No problem.
Wenhan?
Yeah. So thanks so much, Sameer, for the insights. Really appreciate it. And I think, you know, you talked a lot about Buffett and Munger, and I think one of their greatest insights was sort of the use of float capital from these cash generative insurance businesses. So is that sort of a playbook that you've applied when you entered the healthcare sector, and also more broadly, which other sectors do you see as having these float-like characteristics?
Sure. So no, absolutely. So one hand, totally. It's when I say, you know, pick a model that works and copy it as best as you can. Honestly, that is such a good strategy, and that's exactly what we've done. So almost all our businesses. So that's one of our key criteria. Is most of the EBITDA / free cash flow going to be made available to us as shareholders, or is it going to get tied back up into the business in CapEx or whatever else? If the answer is most of it is going to go back into the business, then we're not that interested, right? And same as Buffett, they tend to avoid businesses where most of the free cash flow is used back into capital expenditure, working capital, et cetera. So one of our key requirements is we're buying businesses that are generating excess cash. So every single year, the investment pool is increasing, so we can do better deals, bigger deals. Occasionally we will go away from that strategy. So Chilango, which is a Mexican restaurant group. Chilango is like a healthier Chipotle, right? So, you know, it's a 15-site Mexican restaurant group, which we bought last year in the middle of the pandemic, as you can imagine, for very cheap because of what was going on. That's a turnaround business. And at the moment it's not, you know, it's generating, it's doing really well for itself, but it's not a massive cash contributor to the group. And that's totally okay, because it's still going through, you know, we're still in the pandemic. But yeah, to answer your question, for the most part, absolutely, we're looking for these businesses which have some kind of float characteristics. We haven't quite found one which has pure float characteristics the way Buffett found with insurance companies. I would love to buy an insurance company at some point, by the way. But the other businesses, they are very cash generative, and yeah, that's how we are able to grow.
Perfect. Jules?
Hey, Sameer, again, thank you so much for coming. And Joe, thank you for hosting this. I was curious as to how you actually heard about these opportunities within the private market. I know when you're looking and screening through the public market, it's easier, arguably easier to find these opportunities, or at least screen through them, and it's hard to do so in private markets. And I'm curious as to how you did so, especially at the start with less sector knowledge.
Sure. No, that's a good question. So by the way, there's some finance courses which will tell you about perfect market theory and so on. There is so much arbitrage out there, in particular, Juro smiling. There's so much arbitrage out there, right? In particular in the private markets. I mean, you can have arbitrage purely from which investment bank the company hires to sell itself. So if they hire investment bank B, they're going to ask for an 8 times multiple. If they accidentally hired some regional investment bank based in Manchester, all of a sudden the price is 5 times. So you can just have arbitrage purely based on who you're talking to. So it's almost like a stock is trading at 8x on New York Stock Exchange and trading at 5x in Luxembourg. It's as simple as that, right? So that's where the arbitrage is. So in private markets, there is way more arbitrage because it's not everyone knows what the intrinsic value of their business is, and that's how you make money, right? So how do we get these opportunities? One thing we did right away, me and Irina, is when we started out, we set up a really good website right off the bat. This is back in 2015. We hit our McGill graduation years on our LinkedIn because nobody needs to know how young you are. And we bolstered our RBS experience. Instead of putting investment bank analyst, we changed it to investment banker. So things which gave away our age. We at the beginning you had to, right? We had zero experience. We had practically no capital. You want these advisors to present opportunities to you. So this was back in the day, right? Now, we're a well-respected mid-market operator in the UK M&A marketplace. So we get opportunities from virtually everywhere. So there's a bunch of mid-market investment banks that send us things. We have really good relationship with regional advisors. Some accounting firms have corporate finance practices which send us opportunities. But yeah, it is unfortunately a relationship game. So you have to keep these guys warm. You have to do a bunch of these intro calls, but it's part of the game. But yeah, it's also about having a strong brand. So whenever we do an acquisition, we make a lot of noise about it, and that way there's more comes. Success breeds success typically.
I mean, look, one of the things that I'll highlight from what you just said is just like how important doing networking is, right? And to do networking not in a transactional manner, but in a relational manner, because I'm sure the advisors you work with, you don't work with them just once, you work with them many times.
Absolutely.
And so it's about managing the long-term relationship. And that's something that's fundamentally important for people to realize. It's about doing the networking the right way. And in some aspects, in order to initiate the relationship, sometimes you need to do these little hacks to kind of get to it's like, there's growth hacking to get customers. There's also growth hacking to get credibility. And there actually little details can matter, right? Little things like deleting the year from your
and a beard. You need a beard.
That's
guys.
Right.
When you're 22, you need a beard to look a couple of years older. So yeah, no, absolutely, Joe.
Adil? Oh, wait, I think I might have skipped Leo. Leo first.
Yeah, thanks, Jiro. So hi, Sameer. First of all, thanks for being here today. Really appreciate it. I think this is definitely one of the most unique and interesting events I've been to during my time at McGill. My question is related to the timing of starting your own fund. Of course, there's a lot of factors that should be considered in that decision. And, when you mentioned is like the credibility to LPs. And I think you raised a good point that the kind of marginal credibility you gain from 22 to 30 years old can be pretty low. But I'm curious on the other side, like on more personal side, how ready you felt personally to go that route, and how did you build that confidence in your, investing skills, operating skills, relationship building skills at 22-year old that you can have to start your own fund without a track record, because I would assume a lot of people would try to go into established organization before, learn under people that are older than them before making that jump. But I'm curious to know at 22 for you, how did you build that confidence to say, I'm ready to do this?
It's interesting you ask, right? Because did I have the full, well, did I know exactly what, did I have the full plan laid out? Absolutely not. Were there pivots constantly for the first 3 or 4 years? Absolutely. What's interesting is it was even harder because RBS, where I thought, you know, this is what I wanted to do for a while, because I found the job fairly boring. I wasn't doing the exact product, investment banking product I wanted to do. It was I was in a team called Structured Finance, Asset-Backed Finance. So they were doing a lot of something I really wasn't interested in. So in particular, because of that, I was not very well. I wasn't enjoying my job, and people could see it. So confidence levels weren't at their all-time high by any means. But I think you had to. Well, to be honest, the fake it till you make it thing, which I know it's a bit corny, but it had to be done. I had to just believe that I'm going to be this person, this successful swashbuckling investor. And then I became it. It took a while, but you had to, because if you show up to any meeting, whether it's a investment banking advisor who's going to give you deals, or a lender who's going to provide you with debt capital, or an investor who's going to give you equity capital, you show a single sign of weakness, the deal falls away, frankly, because it's a lot of responsibility. It's not just a job, right? You're running money. So you have to, yeah, I almost had to act overconfident right at the very beginning until you catch up. And I only feel like I fully caught up probably 2019 was when the version of myself that I thought I was portraying and who I actually am finally caught up. So I'll be honest, there were moments of, I don't know if you've heard this phrase, imposter syndrome. Only in 2019, 2020 was, I'm like, you know what? Okay, this is who I am, and I believe it, finally. So it does take a while, but yeah, you have to, yeah.
But by the way, so I mean, a few things to unpack here. So maybe I'll start with the most important one, which is like, you know, one of the things that comes that comes through clearly in what you just said is maybe like the simple answer to Leo's question is, if you wait to be fully ready, you will never do it. And so you need to be willing to take a risk, and being willing to take a risk involves, you know, a few things, right? It involves being willing to seek discomfort, right? By the way, if you guys don't know where that term comes from, X-McGill, Yes Theory, a YouTube channel. So
yeah.
My yet another group of special A-.
Yeah, they're all similar graduation year to me.
No, I know. I know them since before Yes Theory, actually. But also very entrepreneurial, by the way. And it's obvious with the way they executed that stuff. But seek discomfort. That's important. If you wait to feel fully comfortable with something, you'll end up never starting it or starting it too late. The other thing is be nimble and smart about it. So if you're not comfortable, your goal is to get comfortable as soon as possible. And that means orienting the way you do things early on to learn as opposed to earn. That's the early thing. The focus is on learning as opposed to like necessarily scaling super fast and making money super fast. I mean, sometimes you can get lucky and start to get those other benefits sooner rather than later. But the priority should be a growth mindset. And then the final thing is faith, right? You need to have faith in yourself. You need to really believe in yourself. And it really helps you to have faith in yourself if you know who you are, right? By the way, on the faith part, I am kind of curious, you know, the fact that honestly, to me, it's actually one of these beautiful things. It's like the fact that your father was willing to bet everything on you, right? And and by the way, the fact that Irina was willing to bet everything on both of you.
Sure. So guys, just this is the tough part, right? This is the interesting part. And I'm going to unpack it in my annual letter for 2021, because most of the people who interact with RDCP don't quite know how it all started. So the the 2.5 million pounds, $3.5 million, that 2.5 million, my dad, and neither me nor Irina come from wealthy families. We wish we did, but we don't. So my dad, his entire life savings, and my dad is 60 now, his entire life savings were about 800,000 pounds, right? Which is a decent check, but that's all his life savings. He doesn't own any property. He's a very old school guy. He doesn't believe in asset ownership, which anyway, he believes in cash hoarding, very, very Asian thing to do. He gave me all his money, all of his money, which would I do that now? I have a 1.5-year-old son. Would I do that now to my future? I mean, that is crazy. So forever grateful to my father for that. And Irina, who's my wife and business partner, her late father passed away maybe 6 years or so before we set up, 4 years before we set up the business. And she had insurance payout and some insurance money, some inheritance money, which was about to the tune of £1.5 million. And she put all of that too. So that was our startup capital. We were all in, and I felt so responsible. I'm like, I'm betting this girlfriend of mine who trusts me that we're going to make some right investments, and my dad. So there was a lot of, I guess maybe that's why we got a few things right early on, because that's a lot of pressure. It's one thing to lose some third-party LP money, which nobody should ever do, but it's another thing to, your own dad or your Irina, your wife and partner. Yeah.
But I think maybe, that played a role in, in you having faith. I mean, maybe that played a role in you having faith in yourself as well. Is,
Sure.
Sometimes having the right people show you how much they believe. Anyway, for me, when you told me the story about your father, I mean, I kind of needed to reflect on it myself for thinking about my own kids, by the way. So maybe move on to the next question, Adil.
Yeah, sure. So firstly, I'd like to thank you, Sameer, that this was absolutely an absolutely amazing conversation. I really liked the funda, which was done is better than perfect, and I'm absolutely going to apply that to my life. My question is a little specific to do with what you mentioned a couple questions ago, which was that when you spoke about companies generating cash flows for you in this situation of private companies. But what do you do in public markets where even though there are a lot of cash generating companies, these don't necessarily return you the capital in terms of dividends. A lot of them choose to either hoard it or reinvest it in vehicles which may or may not work. What do you do in such situations? And do you still think that public markets can generate the type of returns that private markets can, in your opinion?
Sure. So great question, Adil. No, absolutely not. The public markets cannot generate such returns. It's just not possible. The reason we like majority ownership or total ownership is because we have full and utter say over capital allocation. That is so important. That is the only way we've been able to grow. And if you read some of Berkshire's old letters, I'm talking 60s and 70s and so on, he talks about the exact same thing. It's as simple as that. He likes asset ownership, of a full asset ownership or majority ownership, because then he controls capital allocation. Whilst if you're a minority shareholder, if you own a few shares of whatever company listed on Toronto Stock Exchange or New York Stock Exchange, of course not. I mean, you're irrelevant to them. And that's been a big theme of our investing careers, is we're doing bigger transaction sizes, but I want to control the business so that I can do exactly what we just discussed. Otherwise, it's fine. You can still make a great return, but it won't be the same. And frankly, you know how much we started with, and our first few acquisitions were, our first acquisition was £2.5 million. Second acquisition was £3.2 million. 70% of that was debt, 30% was equity. You can do the math for yourselves. It's not that much capital. I'm sure most of us here could accumulate that capital, whether it's friends and family. You can do it. In particular. And I was talking to a Canadian investment banker friend of mine who sold a business to us most recently. He's a partner at a mid-market investment bank, and he's Canadian. And he was saying, Sameer, your model would be so well done in Canada, definitely not in the US, because the US has way too much competition. You're just not able to you're not going to be able to pick up businesses at the multiples we have pulled off. But in Canada, in the 1 million to 10 million Canadian dollar EBITDA space, there's practically no activity. So you could pick up these perfectly good businesses, retiring entrepreneurs, their kids don't want it because their kids want to go work at Goldman Sachs, that are selling at great prices. So if any of you want to set up your own RDCP, Canada is a place to do it, frankly. The opportunity is there. And the market, lenders are great, service providers are great. Canada's and the UK, not the US. The place to do it.
Thank you so much, Sameer. Thank you so much.
No problem.
Maybe one last question from Matt.
Yeah, so when you're assessing your opportunities, how are you like looking at things both, I suppose, from a financial perspective, whether it's like, IRR, free cash flow, NPV, and what's like your hurdle rate that you need to, has to be above before you invest? And also from the lens of like psychology and multidisciplinarianism, like Munger always emphasizes, like inversion, and looking at through different models. How do you sort of look at these investments and weigh out which ones are the best ones, and how and say where you want to allocate your capital?
There's a few things. So our rejection rate, by the way, and I don't put this on our website because advisors won't talk to us, but our rejection rate is about 99.1% or something stupid like that. So we reject most things we see. Because most businesses are pretty shit. Actually, most things are not, if you think about it, most things are not that good. So I'm very proud of our extremely high rejection rate when it comes to investments. It's a few simple things, Matt. So we reject typically on size. So, business has been doing X and all of a sudden it's doing 3X, which is a knee-jerk reaction to COVID-19 for whatever reason. They're selling a bunch more of their product. So we reject things like that. Or we'll buy it as long as you value it on what it was doing before, not what it's doing now. But to answer your question, I never need to get super theoretical about it. I've never built a DCF model for anything we bought. We don't need to. The only analysis I really do is price to EBITDA. Like that is really the only thing I care about, because that allows me to compare it to other things we bought, other things in the sector, other deals that have happened recently. Frankly, that is by far the main driver. And you can do some back of the cigarette pack calculations very quickly. Instead of EV/EBITDA, you do EBITDA to EV, and all of a sudden you're like, that's a pretty decent return. So my goal is I want to buy this cash flow generating asset for as little as physically possible. That is my constant goal, because the less I pay for it, the quicker it deleverages. If I'm borrowing some money, the more free cash flow is available to me to reinvest into future things. But to answer your question, because of the deals we've pulled off in the last 6 years, and some of them are just bonkers prices, right? The EV/EBITDA is just like, if I tell Jiro, he's just going to be like, you're lying to me here. So some of them are just super cheap. Like, why did people give it away? Bit of luck, bit of circumstance. So I'm comparing it to that, which is not always best, because you should look at the current market environment, but I am constantly comparing to what we just paid or the average EBITDA multiple of all our transactions. So I have a moving Excel file that's called the RDCP master model, which has constantly, it has the current EBITDA, day one EBITDA when we bought it, price we paid. So it has a moving sort of EV/EBITDA, and then the things we're looking at, all the live transactions, all the soft transactions, which might go live. So that's how I'm constantly comparing. But to give you an answer, if it's over 6 times, I'm not that interested, which I know for most investors, over 6 times is still a decent deal. But our current approach is it has to be cheaper than 6 times, then I'm going to be interested. But then a few other things, appropriate management team, the reasons for sale need to be very clear and appropriate. But yeah, typically those in combination, and then it all comes back to gut feeling. Ignoring your gut is a terrible thing to do in a number of situations in life, but definitely in investing, you've got to listen to your gut.
Well, I mean, maybe on the gut thing, what I would say is it depends, right? Like there are parts of my gut that I should listen to, and there are parts of my gut that I should absolutely not listen to. If your gut is telling you panic and sell when everyone else is panicking and selling, it would be a mistake to listen to that part of your gut. So there's some, you want to kind of, and that goes back to self-awareness. of knowing what part of you should listen to and knowing which part you should not. By the way, I did notice that you said you would never do a DCF, which is precisely reemphasizing what makes you a special A- student, because you apparently did not decide to put that in your bag of tricks after taking my ACF. I mean, by the way, I'll say one thing. Like maybe you don't feel like you need to do a DCF because you focus on the universe of opportunity, where a DCF is not necessary because you're getting a good deal. And so in some sense, what you do is you scan for the part of the market where things are not very competitive. And so you don't need a fully fleshed out model to figure out whether you're paying 5% too much or getting 5% discount, because you're looking for things where you're getting a 40% discount. And if you're getting a 40% discount, there's no need to like over perfect the model. The model will just tell you what you already know. You're getting a great
natural margin of safety.
And in fact, analysis by paralysis or something like that.
Analysis paralysis.
Yeah, that thing. You run a risk of having that happen and not acting fast enough. In the subset of the space of opportunity that you focus on. And you're right. I mean, there are some cases where don't overthink it. Right. Look, I mean, I think maybe at this stage, we'll kind of get ready to wrap up. But there was one comment that Adil made. Adil, in asking his question, he used a word that I liked a lot. He said, I loved not this event, or this lecture, but he used the word conversation. And I think that's a really great word to use here, because this really was a conversation, and it was a conversation between you and I, but also with many, many students. And one of the things that I want to say is, I think this is actually a really good way to learn, right? Actually learning by conversation, where things are a little bit more interactive, and where we focus on like big picture things, I think is a nice complement to the classroom. And so this is something that I hope that we have the opportunity to do more and more. And I think this just kind of really wonderfully illustrates kind of how valuable this can be, because I feel, at least I myself, and we've had these conversations many times before, Sameer, is I learned a lot today. And I can only imagine what students have learned. So
we unpacked properly today. No, I really enjoyed that. I really enjoyed that.
Same here. And I'm sure I echo the sentiments of every student that has come in here today in really saying a big, sincere thank you for being generous with your time and being generous with your perspective, both in terms of your experience, building RDCP Group so far, and also sharing, a bit about yourself so that we can actually put context on it all. And if you really think about it, it all makes sense. Right.
Thank you.
So thank you so much, Sameer, and we definitely hope that this is chapter 1 of multiple chapters. Sameer X McGill.
I would love to, and I'd love to come down at some point. I haven't been to Canada since graduation, so I'd love to do this in person. It's so much more fun, right? More,
100%. You tell us when, and it'll happen. And absolutely would be lovely to see you back in Montreal, because I'm sure you have fond memories of our city and our community as well.
Awesome city.
Thank you so much, man.
Thank you guys.
And thank you to all the students for the great questions as well. This was wonderful. Maybe one final thing, building on what Sameer just said, if anyone decides they want to do RDCP Cub Canada, and I think you know what I mean by saying that, i.e. want to do the Canadian version of RDCP, let's set up a Zoom call between Sameer, myself, and you. And if Sameer says, I think the person can do it, I shall seed a little bit, and you'll have at least one LP.
Done.
That's my attempt at a joke, which is why I should never quit my day job.
No. No, guys, honestly, you can see how I've done it, and it was super simple. It is as simple as it sounds, so it can be done. And I only graduated in 2014, so it's only been a handful of years. And Canada is the right marketplace to do it. I wouldn't recommend this to anyone in the US because it's just super competitive. You're going to pay stupid prices or you're just not going to find a deal. But in Canada, go for it. And it'll take one transaction to pay you 5 years worth of starter investment banking salary. So it can be very profitable if you get it right.
Oh, someone is asking access to shareholder letters. You make them publicly available on your website, right?
It's on the website. Yeah. Check out rdcpgroup.com. Everything is everything is available there. Annual letter section.
Thank you so much, Sameer. This was wonderful. Look forward to catching up again. Please say hi to Irina for me.
Will do.
And
Will do.
Congratulations with everything, man.
Thank you. Thank you, guys.
Have a wonderful
Catch you later. Take care.
Ciao.
Bye.